Welcome to the Monocle Banking Podcast, curated by Monocle Solutions. Now, retail banking is certainly being rewired at the moment. Anyone who is engaged as a consumer, a customer of a retail bank will tell you that payments are being unbundled, the data is edging closer to portability, AI is everywhere and it's moving from experimentation to enforcement risk, and we're seeing crypto also colliding head-on with our exchange control regulation. So in South Africa, when we talk about this, it isn't abstract. I mean, the payments ecosystem modernization program is opening the rails. Non-banks are pushing closer to that core. We see the regulatory perimeter expanding and not shrinking, with the likes of COFI, AI governance, crypto licensing, and embedded finance all landing on balance sheets and on boards at the same time. So the question for 2026 isn't where the fintech is coming. It's who carries the risks, who owns the customer, and who really controls the infrastructure. And to help us unpack all of that, I'm joined by Lerato Lamola, who's a partner at leading law firm Webber Wentzel, one of the sharpest legal minds at the intersection of banking and fintech and payments and digital assets. And today we're going to be talking about all of this as well as the regulatory sandbox. So Lerato, it's great to have you with us. Just before we get into the year ahead, and I want to understand the lens that you bring, because when you discuss fintech, it looks very different from a product room than it does from a boardroom or a regulator's office. What shaped your career path into fintech and financial markets law?
Thanks, Michael. I think it really just started with a passion for regulatory law. So every industry is highly regulated. And after my law degree, I knew that I wanted to be in the regulatory space. And how I ended up in the financial sector is I started at Standard Bank. And in the early 2010s, which feels like forever now, Standard Bank was actually quite focused on its stakeholder management, but really trying to understand how the regulatory universe impacts its clients, its business, its products. So I found myself in a little unit at the time in group risk, looking at regulation from a risk perspective and then building in those pieces. Because I think, as you've noted in your introduction, regulation overlaps. So, you may be in the banking space, but as a bank, you're impacted by things that happen in the real estate sector, things that happen, on the consumer front. So everything intersects. Hence why we found ourselves in a risk function as opposed to a legal or a compliance function.
Yeah, and it's understandable given that it's a four-letter word that bankers are most familiar with risk. And as a regulatory specialist, and through the course of your career, what's the one misconception that either founders or internal founders, those innovators inside the bank and the organization who want to come and do something new, and they say, Lerato, we want to do this. What's the one misconception they might have about regulation when they pitch this new disruptive thing that they want to do to you?
I think they view regulation as a boundary/hindrance, where actually regulation is, there's so many opportunities within the regulation itself to innovate. So I find that the founders who get the most traction are actually the ones who are able to look outside the box and really innovate around what are perceived boundaries, because it is actually in those boundaries that we find the most innovative solutions.
And do you see a difference in advising maybe an incumbent bank and coming from where you did inside one of the big banks in Standard Bank, maybe versus a venture-backed fintech? Is it speed? Is it risk appetite? Is it culture? Or is it just kind of honesty about where the bodies are buried? What do you say is the biggest difference between advising the two?
So I think the biggest difference is, so with your traditional financial institutions, because they are so big and they are machines, they cannot innovate as quickly because they're dealing with legacy systems, they're dealing with, culture issues. They are also aware the cap of their main license. So if you're dealing with a bank, the main license that they have is a banking license and they come from that lens, right? or if it's an insurer that's trying to innovate, the main cap or lens that they're wearing is that of an insurer. Whereas with your fintechs, because they stepping into this world, and they're looking at it holistically, they don't come with any particular lens, hence why they're more adaptable, flexible, and they're happy to, change a system, which they can because they're like usually a lot smaller. They have the ability to change their system quite quickly as opposed to your more traditional financial institutions.
Absolutely. And it's that agility that I think a lot of the incumbent banks are really grappling with. I would probably hazard a guess to say that Capitec have got it about right. And it's unsurprising that they're also the newest in the banking market. I mean, they've been around now for 25 years. So they're
Mm.
starting to mature, but they really came at the industry when everyone looked at the banking industry and said, oh, there's no way you're going to compete. It's almost
Mm.
oligopolistic in its structure. You've got the big four, maybe big five, very difficult to break into them. And they've got these big moats. And Capitec just saw it differently. And they said, well, you know what? If we can do things just slightly differently, if we can open a branch on a Sunday, for example, change our operating hours, make the structure of what we offer just a little bit simpler, we think we can definitely serve an underserved base of the pyramid. And now they're migrating up the pyramid. So it just shows you what you can
Mm.
do within the space. What has been the biggest learning for you over the last sort of 15 years, watching the industry evolve and how it's adapting to all of these changes in the retail banking battleground?
I think critically start with the consumer. Understand your consumer, understand where they live, understand how they move, understand their relationship with money. The more you understand the consumer, the more you'll actually be able to provide them with the products and services that they actually need. And if I look at all of the players in the market, so banks and non-banks, who are in this retail banking space now, I think the players who are getting the most traction are the ones who actually understand their consumers.
Again, you're speaking exactly to what Capitec have done well. They really did understand the consumer. Every time I interview Carrie Faree, it was very simple. He just said, we eat, sleep, breathe, dream customer centricity. And I suppose the results, the proof is certainly in the pudding. When we come back to, let's look at the regulatory environment and what banks are facing today, financial services firms in general. You've got COFI, which is the Conduct of Financial Institutions Bill. It really is designed to be this umbrella market conduct statute under the Twin Peaks model. Prudential rules sitting with the PA, the Prudential Authority, while your conduct rules sit with the FSCA. And if you look at what COFI's purpose is, it's to streamline and modernize conduct requirements across the sector. So what do you think are the advantages under COFI for fintechs as this battle to get to the hearts and minds of the customer heats up?
So I think Kofi will hopefully bring uniformity and certainty. So currently, each particular player is regulated by their own piece of legislation. So, you have pension funds on one side, asset managers, insurers, bank. So all of them have their own consumer protection provisions weaved into those standalone pieces of legislation. And the whole idea is that it's meant to be the one-stop shop from a conduct perspective. So when we look at what are the consumer protection principles that all financial institutions should be applying, we would look to COFI. So I think that's the positive. However, I think there are some challenges within COFI as well because we come from a very fragmented regulatory environment and trying to pull all of these different players under one umbrella is
Yeah.
quite challenging.
Yeah.
And that is going to be really where we'll see how successful Kofi can be, will be in its actual implementation.
Because, yeah, I mean, that activity based regulation, that perimeter widens, doesn't it, to your point?
Yes.
So, which fintech business models do you think are most exposed to being pulled into the regulatory perimeter under COFI? Maybe they might not think of themselves as financial institutions because we've got so much happening. You've got embedded finance, you've got these wallets, you've got buy now, pay later, you've got crypto platforms. Who's currently flying under the radar? Probably won't be under COFI.
So if I think about anyone who's trying to provide digitized financial services, so it's things like crowdfunding. And these are things that I don't think anyone's actually thought about. So anyone who's providing a crowdfunding platform, So that's your platforms where, someone has a business, they want to get investors, so they'll probably pitch their business online and, members of the public will take up the offer. Our buy now, pay later, they find themselves in a gray area where there is argument to be made that they could also fall under COFI. Our crypto assets, our service providers, and everyone who's in that crypto universe, right, could potentially find themselves within COFI. The other industries, which again have also said that they think they probably will be dragged in, is debt collectors, right? But not debt collectors as we find them under the NCA. We have other type of entities that are collecting debts on behalf of third parties. So basically, all of these activities which have a financial element to them could potentially find themselves dragged into COFI because COFI uses very broad definitions. And the broader the definition, the wider the scope. So, one of the things that I've been advising clients recently is if you have any part of your business that has a financial element to it, please take the time to go through COFI, and do that assessment now because it will be very difficult later on, to get your house in order.
It's such an important point because I'm sure there are many fintechs out there who might be playing in sandbox who might not realize this. And I suppose the
Yeah.
uncomfortable question is also, whether or not it ultimately levels the playing field between banks and fintechs, or whether it maybe entrenches the incumbent, because the incumbent often is bigger and can afford compliance. They can afford to come to you, Lerato. And if you're talking to a fintech, which is maybe 3 students out of UCT in a dorm room in Claremont, slightly different from that perspective. Do you think the regulation gets the balance right to be all encompassing, to widen the perimeter while not stifling innovation and maybe tilting the playing field towards the incumbents?
You raise a very important point, Michael. And I think this is where we always argue for proportionality in regulation, right? Not every regulated entity has the same capacity or capabilities. So if we take our 3 friends who are at UCT, we wouldn't want to impose the same compliance obligations that we would put on a fully fledged bank. However, what COFI or what any piece of regulation is meant to be addressing is a specific mischief. So you have to ensure that the proportionality actually addresses the mischief slash the risk that you're trying to address. And I think that's for me what I'm most interested to see once COFI becomes a law is whether our regulators are going to get the proportionality aspects correct because it costs a lot of money to build systems, to build compliance processes, to get the human resources, and those things in place to actually get your business going. And the beauty of fintech is that because a lot of the processes are digitized, you don't necessarily need to have a physical office. You don't necessarily need to have human bodies doing certain of the functions. So it will be interesting to see whether our regulators appreciate or will be able to translate the provisions for this digitized world, that we're trying to find ourselves in.
Such a great point, an insight there, that idea of proportionality and how it's implemented, because 5 years from now, whether or not we can say COFI actually worked, I think will really hinge to a large extent on this particular point as well. Speaking of innovation and payments, really is where we're seeing a lot of innovation. Lerato, at the moment, it's amazing because it wasn't that long ago that payments was just kind of the dumb pipes or the rails that was all operating unseen to consumers. Banks have kind of had this quasi-monopoly that was built, but has now become Pay Inc. Everything's opened up. We've got the RPP, Rapid Payments Program. We've got Modernization, we've got PaySharp, we've got the different players coming in. You just look at your cell phone. Sometimes you don't know whether to scan with your Google Wallet or Zapper or SnapScan or what app you're going to use. I mean, it really is bewildering. But when we look at regulation, a lot of the payments reform, I think, is where a lot of the ideology maybe meets the plumbing. And we've got the PEM program talking about shifting South Africa to a higher equilibrium. What does that actually mean in market structure terms?
So the whole idea is to get as many South Africans tapped in, i.e., give them access to financial services. South Africa is still quite a cash heavy country. And part of the barriers to getting more individuals into the financial system is originally we thought the issue was that people don't have access to bank accounts. But I think what the last 5 years has shown us is that actually it's not the access to bank accounts that is actually the issue. It is the access to fast, efficient payment rails that allow for real time settlement. That is actually what people want access to. So the PEM program PEM has identified several things, right? So there's the infrastructure. So actually ensuring that South Africa has the correct infrastructure and payment rails to make these payments happen. The other thing is making sure that individuals have access to what they call a digital identity. So the whole idea is that obviously you need to have access to digital payments. You need to also have the tools to make those payments possible. So at the end, right, when we get to the end of PEM, if it actually achieves everything that it's intended to achieve, we will have more South Africans operating digitally when it comes to them, accessing their financial services. And linked to that is we will have this digital identity, which we will be able to use not only in the financial sector, but obviously then it also implicates home affairs. And I think there was discussions around also hopefully using the digital identity within the health sector. So it is quite a ambitious project, but I think we are getting there.
And just looking ahead for the rest of the year, what kind of regulation do we still need to see to help us get there, to ensure that we are genuinely moving towards meaningful non-bank access?
So the main or two main pieces of draft regulation that are out there right now, it's the draft authorization framework. And what that is, it's going to require all those who are busy with payments activities will be required to be authorized by the SARB and the National Payment Surveillance Department, the NPSD. And then the other piece of regulation is what we call the draft exemption. So everyone who's providing digital wallets will be able to operate under the draft exemption, because currently how our law is drafted is if you provide a digital wallet, because of our laws, you're technically providing a bank account, which have required you to either have a banking license or partner with a bank.
Yeah.
So this change actually will now mean that non-bank entities will be able to provide digital wallets without necessarily having to partner with a bank. So it's quite a big change. And I know the non-bank entities within the industry are quite excited with the prospects of this draft regulation becoming law.
Yeah, and I know the Payments Association of South Africa, which was formed as an industry body to effectively represent those non-bank players, is really keen. They see their profit pools to be attacked there. And if non-banks can participate
Mhm.
more directly, what
Mm.
happens to the pricing power in payments that the incumbents have? We're certainly going to see a lot more innovation, the speed of that increase. But I mean, coming back to your risk lens, does all of this also potentially increase systemic risk? And, we've got to be mindful that we've just come off the grey list. But now you've got all of these non-banks who are maybe not as regulated as the banks, and we've got to ensure that we can trace money flows. Do you think we are potentially introducing a bit more systemic risk into the system?
So I think our regulators are very, very focused on this particular point. And the draft regulation actually builds in AML provisions. It also requires all applicants to provide capital. So they have introduced prudential requirements for the non-bank entities, which is I think that was a bit of a shock for some of the players. But to your point, because non-bank entities are going to have direct access to the payment system, we need to make sure that they have the appropriate governance structures, appropriate AML mechanisms. So the regulation has built in those things to deal with that risk. What will be the real test is actually seeing how the regulation is implemented once it actually goes live to see whether the current provisions actually address the risk.
And, that feeds also into crypto and blockchain, which have now started to really become a lot more formally regulated, because we saw the crypto asset service provider licenses come out towards the back end of last year. Interestingly, chatting to someone at Treasury earlier this year, they were saying that, yes, while we're off the grey list, we're certainly not out of the woods. And apparently there's going to be a follow-up FATF meeting early next year. And one of the areas in particular that they are looking at is, tightening those regulatory loopholes around crypto and stable coins. And from your perspective, I'd like you to hear, where do you potentially see those loopholes? Because you have said that 2026 is the year of stable coins.
So I think the one question which we are all waiting to get some certainty around is crypto and exchange control.
Yeah.
So when crypto is transferred, outside of our borders, what is the position? Because currently our exchange control regulations are just not written for this digitized environment. And we know later this year, we're waiting to hear the outcome of the SARB's appeal in the Supreme Court around whether or not crypto classifies as capital for the purposes of exchange control. I think the other area which needs to be addressed just to provide more certainty is, so currently crypto is not legal tender in South Africa. So as much as we are seeing all of this development in the payments industry, we need to appreciate that crypto technically doesn't fall within that. So then the question becomes, well, when you have these providers who are doing your crypto payments, right? So part of the payment is in cash, part of the payment is in crypto. I think we need to just apply ourselves a bit more there, and be clear, you know, where does the regulation start? Where does it stop? What are the requirements and who bears the risk in those type of payment flows? So I think those are the two big areas for me this year that I want to see some certainty on, being exchange control and crypto payments, and specifically now just touching on stable coins, just providing more clarity there.
Well, I mean, exchange controls for me is certainly my personal big one. And just at a
Mm,
very personal level, I just find exchange controls are a complete anachronism in a modern day South Africa, which runs a very modern, open economy. And, one might argue and point to the fact that thankfully, during the global financial crisis, it insulated us to some extent. But, when I chat
mhm,
to founders, when I chat to the VC industry, there's a lot of negative damage that is being done because of exchange controls to raise funding for new businesses. Investors don't want to be investing in an economy where they see it might be difficult to repatriate funds. And so they set up structures in Mauritius or elsewhere. And we end up losing often that founder when they then have to go abroad to raise funds to maybe grow their startup. And so that Standard Bank versus Saab case going to the SCA hopefully will force us to ask more broader searching questions about what is the role of exchange controls in a modern South African economy. Because from where I sit, crypto absolutely makes a mockery of exchange controls. So what do you see? Paint two scenarios. Let's say the SAA favors the SARB. What do you see tightening immediately? But if the case goes in favor of Standard Bank, what do we see breaking and what must lawmakers then fix next?
yeah, so I think if the case goes in favor of the SARB, I think we will see probably regulation or guidelines around information that has to be reported, and almost classifications as to who can actually perform these transfers, right? Because whoever is allowed to perform the transfer is the individual who would have to report on what flows are actually happening. If the case goes in favor of Standard Bank and the outcome being that crypto is not capital for the purposes of exchange control, I think we will see an amendment to the actual exchange control regulations where it is explicitly stated that actually crypto is actually capital. So I think either way, regardless of how the case goes, our regulators have indicated that they do intend to close the gap. They're just waiting to see what happens with this case, but I think either way, their intention is to close the gap.
Yeah, I still think if you want to be leveling the playing field, that exchange controls again unfairly benefit the incumbents. Because, I mean, if you just think about what happens in the process of trying to move money offshore, the
Mm,
banks who are really, they're the ones who are the intermediaries, acquire all this IP from VCs, they acquire it for free. And I mean, often we lose capital formation as a result. So it's one of those things that's a huge thorn, I think, in South Africa's side is
yeah.
exchange controls.
Michael,
Yeah.
just on that point, I think, we mustn't forget that the other part of the conversation that we also need to appreciate is, so Africa as a continent is trying to create regional payment rails, right? And to your point, then the question becomes, where does exchange control fit into the regional rails that we're building? So You may have heard of PAPS, the Pan-African Payment Settlement System,
Yeah.
which is being built. I think currently there are around 18 central banks that are signed up onto it. South Africa is not a member yet. We hope that we will actually get on there. And the whole idea around PAPS is it's cross-border settlement of payments, and it doesn't involve dollar or euro settlement. So I will be able to send rands to Kenya and whoever I send my rands to, they will be able to be settled in shillings. So yes, I think it's great, and it is very important that South Africa modernizes its payments infrastructure. It is very important that we complete this PEM program. However, South Africa also needs to start being more involved in the regional conversations that are happening, because otherwise we will get left behind and we will be excluded from those regional initiatives.
So just as a last question, Lerato, to me sounds like we need to focus a lot more on regional harmonization. So what's realistic then in the next 24 months? Do we need to focus much more on mutual recognition or shared standards, or just better regulator to regulator communication?
I think all of the above. So there are things happening under the African Union. I know that they are re-energizing, revitalizing AfTA. Sorry, I can never pronounce that word.
Neither can I. Don't worry. Terrible acronym then.
So PAPS is actually one of the initiatives under AfTA. So that's one of the regional things that I think, with South Africa's membership to the AU, with its involvement in AfTA, that is our way to be part of those conversations. It's the regulator to regulator conversation. So to your point, a lot of these non-bank fintechs operate regionally, right? They are borderless. They have offices in Ghana, Nigeria, Kenya, South Africa. So where you have a platform that's operating cross-border, we would want the regulators to be on one page. Currently in West Africa, they've been piloting what we call fintech passporting, where you have one license and it applies in all of the countries that you actually operate in. So I think South Africa needs to be thinking about those type of initiatives and having those type of conversations with their counterparts across the continent, because I think Africa as a continent is becoming quite a large fintech hub, and South Africa has always been thought of as one of the gateways into Africa.
Well, thank you very much, Lerato. Very considered conversation. I think what's clear from it is that the winners won't just be the fastest movers, but the firms that really understand the kind of regulation as architecture and regulation not as friction, to your earlier point. Yeah, the payments reform is going to reshape the market across the region. Crypto is going to mature under more legal pressure, not on more libertarian slogans, and I think conduct regulation is going to decide who gets to scale and who doesn't. Thank you very much, Lerato Lamola of Webber Wentzel, for a very grounded and unsentimental look at what's coming. Well, that's it for this episode of the Monocle Banking Podcast. If you enjoyed the conversation, follow us wherever you get your podcasts, and do join us next week as we continue to unpack the forces that are reshaping your banking, markets, and money. I'm Michael Avery. Thanks for listening.